Hey everyone, welcome back to Corporate Decoder. Today, Worksport Ltd just filed their preliminary proxy statement for their 2026 annual meeting, and I am seeing a big proposal that could shake up the stock. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is asking shareholders to approve a massive stock split authorization, and this could be a make or break move for their stock price. So what exactly is this filing all about? It is a preliminary proxy statement, which means it is a heads up to shareholders about the upcoming annual meeting. Think of it as an invitation to vote on important company matters. This document lays out everything shareholders need to know to make informed decisions before the meeting. The company is Worksport Ltd, ticker symbol WKSP. They are in the auto parts business, and as you can see from the headlines, they have been through a lot recently. We are talking about a company that has had some financial struggles, and they are looking for ways to improve their market position. The big event here is the 2026 annual meeting of shareholders, scheduled for the 3rd of September 2026. This is where shareholders get to vote on the company's future, and believe me, some of the proposals on the table are pretty significant. First up, they need to elect directors. This is pretty standard. They are proposing the same 5 people who are on the board now to continue their roles. Stephen Rossi, Lorenzo Rossi, Craig Loverock, William Caragol, and Ned L. Siegel. Next, they are asking shareholders to approve the company's choice for their independent auditor, which is Lumsden and McCormick, LLP, for the year ending the 31st of December 2026. This is also standard procedure to make sure the books are being checked properly. Proposal number 3 is interesting. It is an advisory vote on whether shareholders support the board considering special dividends if the company sells off a business unit or a major asset. This basically means shareholders are giving the board a thumbs up to potentially return cash to them if the company does well in selling parts of itself. Now this is the big one. Proposal number 4 asks for authorization to do 1 or more stock splits. This includes reverse stock splits anywhere from a 1 for -2 ratio, all the way up to a staggering 1 for -250, or even forward stock splits. The board gets to decide the exact timing and ratio, and they can even back out of it if they want. This is a huge amount of power for the board regarding the stock structure. Finally, proposal number 5 is a backup. It is asking shareholders to approve adjourning the meeting if there is a need to gather more votes or information. This is pretty common to ensure all business can be handled smoothly. So at a high level, the board recommends voting for all these proposals. They believe these actions are in the best interest of the company and its shareholders. Now, let's dive into some of the questions and answers that clarify how all this works. They're using a method where they send out a notice telling you how to find the proxy materials online. This is a cost-saving measure and is pretty standard practice these days. They believe it is a faster way to get information to shareholders while also being better for the environment. The meeting will be held in person at their corporate headquarters in West Seneca, New York, on the 3rd of September 2026. Shareholders of record on the 7th of July 2026 can attend and vote in person. Anyone who owned common stock or series of preferred stock as of the 7th of July 2026 can vote. Now here is a key detail. While there are over 15 million shares of common stock, the series of preferred stock, all owned by Stephen Rossi, the CEO, carries 51% of the total voting power. That is a lot of control for one person. The Series C preferred stock, however, has no voting rights. To have a valid meeting, at least 1/3 of the total voting power must be represented, either in person or by proxy. We've covered these already: electing directors, ratifying the auditor, advisory vote on special dividends, the stock split authorization, and the adjournment proposal. For electing directors, you can vote for all of them. Wisconsin holds your vote for all, or withhold your vote for specific individuals. The 5 nominees with the most for votes will be elected. Here, you can vote for or against the appointment or abstain. If the appointment isn't ratified, the audit committee will re-evaluate their choice. You can vote for or against this advisory resolution or abstain. It is non-binding, meaning the board will consider the shareholder vote, but isn't forced to act on it. This is the big one again. You can vote for or against this proposal. Approval requires a majority of the voting power entitled to vote. Importantly, abstentions and broken non-votes count as a vote against this proposal. And remember, Stephen Rossi controls 51% of the voting power. He has indicated he will vote for this proposal. For adjournment, you can vote for, against, or abstain. Abstentions will count as a vote against it. This is crucial. If your shares are held in what is called street name through a broker, they can only vote your shares on routine matters without your specific instructions. For Proposal 2, the auditor ratification, brokers can vote, but for all other proposals, including director elections and the stock split, they need your instructions. If you don't provide instructions, your shares won't be voted on these important matters. Abstentions and broker non-votes are counted for quorum purposes, but for most proposals, they effectively act as a vote against. For director elections, they have no effect on the outcome. But for Proposal 4, the stock split, they will count as a vote against. Yes, you can. You can change your vote online, by phone, or by mail as long as it is before the meeting. If you don't specify, your proxy will be voted for all director nominees, for the auditor ratification, for the advisory dividend proposal, for Proposal 4, the stock split, and for adjournment, effectively going with the board's recommendation by default. This section details the director nominees who are all current directors. The key takeaway here is that directors are elected by a plurality of votes cast. This means the 5 nominees with the most for votes win, even if it is not a majority. Here we see details about the company's top people. Stephen Rossi is the CEO, President, and Chairman. He has been with the company since 2014 and has a lot of entrepreneurial experience, especially in the automotive sector. It is worth noting he is also the father of Lorenzo Rossi, who is also on the board. And he owns all the series of preferred stock, giving him that 51% voting control we talked about. Jennifer Kartachak is the CFO and has a strong accounting background with experience at Ernst & Young. Stephen Rossi's background includes founding automotive companies and being instrumental in turning a New York facility into a manufacturing hub for their tonneau covers. His experience in managing and growing automotive businesses is highlighted as a key qualification. Jennifer Kartachak's experience includes over 10 years in public accounting, 5 of which were with Ernst & Young. She also worked at Moog Inc., gaining extensive experience with sexy reporting and financial management. Dr. Lorenzo Rossi, Stephen's father, is a director and also the CEO of Terravis Energy, a subsidiary of Worksport. He has experience in clean energy technology and financial oversight. Craig Loverock is a director and chairs the Audit Committee. He has extensive experience in accounting and finance. William Caragol is a director and leads the Compensation Committee. He has experience as a managing director of a corporate advisory firm and has held CFO roles at other public companies. Ambassador Ned L. Siegel is a director and chairs the Nominating and Corporate Governance Committee. His background includes international business management and his service as the US Ambassador to the Bahamas. Directors serve 1-year terms, and officers are appointed by the board. Lorenzo Rossi and Stephen Rossi are father and son. No other family relationships among directors or executive officers are noted. There are no material legal proceedings involving directors or executive officers that require specific disclosure. The company has a code of conduct that applies to all directors, officers, and employees. Their policy prohibits unauthorized disclosure of non-public information and misuse of material non-public information. Insiders have restrictions on trading securities outside of designated windows or pre-approved plans. The board oversees risk management, with management responsible for day-to-day identification and assessment. The Audit Committee specifically looks at financial reporting, cybersecurity, and internal controls. Craig Loverock, William Caragol, and Ambassador Ned L. Siegel are considered independent directors. The table shows how members are distributed across the Audit, Compensation, and Nominating and Corporate Governance Committees. Mr. Loverock is noted as an Audit Committee financial expert. The Audit Committee, composed of the 3 independent directors, has significant responsibilities including overseeing the work of the independent auditors, setting audit fees, and ensuring compliance with laws and regulations. They held 5 meetings in 2025. This committee handles director and executive compensation, incentive plans, and performance evaluations. William Caragol chairs this committee. This committee identifies director candidates, reviews board performance, and recommends governance guidelines. Ambassador Ned L. Siegel chairs this committee. The board met 2 times and acted by written consent 13 times during 2025. Nevada law limits director liability, and the company's articles of incorporation reflect this. This table shows a comparison between executive compensation and the company's financial performance. For Payo Stephen Rossi, his total compensation was over $1.2 million in 2025, but the compensation actually paid was much lower at around $450,000. Stock options are a significant part of his compensation. Net sales saw a huge jump from 2024 to 25, growing from $8.4 million to $16.1 million. However, the value of an initial $100 investment based on total shareholder return dropped significantly from $149.75 in 2023 to $24.33 in 2025. This points to a struggling stock price despite sales growth. Looking closer at Stephen Rossi's compensation, in 2025, his salary was about $303,000, but with bonuses and stock options, his total compensation was nearly $1.3 million. The The value of stock options granted in 2025 alone was over $844,000. This section highlights that while net sales increased significantly, the stock price saw a massive drop of over 75% in 2025. The company believes the compensation paid to its payo was below industry standards, which is an interesting point given the stock performance. The audit committee confirms they've reviewed the 2025 financial statements with Lumsden and McCormick LLP and discussed the firm's independence. They recommended the financial statements be included in the annual report. This section details the compensation for named executive officers. For Stephen Rossi, the payo, his salary in 2025 was around $303,000, with stock awards and options adding significantly to his total compensation of about $1.3 million. The notes mentioned consulting fees and bonuses, reflecting the complexity of his compensation structure. Worksport has a consulting agreement with Stephen Rossi through his owned entity, 2,230,164 Ontario Inc. This replaced his previous employment agreement. The compensation includes a base fee of $300,000 and eligibility for a bonus. He also received a stock option grant as part of this agreement. This table shows the equity awards held by executives. For Stephen Rossi, there are a significant number of unexercised stock options. Many of these options have had their strike prices adjusted over time. For example, options granted in 2021 and 2023 were later repriced in 2024 to $7.042 per S-share, which is a common practice when stock prices fall significantly. Worksport has several equity incentive plans, the 2015, 2021, and 2022 plans. These plans allow the company to grant stock options, restricted stock, and other equity awards to employees and directors to incentivize them and align their interests with shareholders. The 2022 plan has an evergreen formula that automatically increases the number of shares available for grants based on outstanding shares, a common feature designed to ensure future equity compensation. Directors receive a mix of cash fees and stock awards. Independent directors Craig Loverock, William Caragol, and Ned L. Siegel received compensation, including retainers and committee fees. Lorenzo Rossi, who is not considered independent, also received compensation. The table shows aggregate fees earned and the value of stock awards and options granted. For instance, Craig Loverock received over $100,000 in total compensation. William Caragol received over $270,000 and Ned L. Siegel over $125,000. Lorenzo Rossi received over $164,000. The company has a clawback policy that allows them to recoup incentive compensation if there is a financial restatement due to fraud or misconduct. The company states they don't have a set schedule for granting equity awards, and each grant is considered case by case. They also emphasize that grants are not timed to take advantage of material non-public information. This table shows who owns the company's stock. Stephen Rossi is the largest shareholder among management with over 796,000 shares, representing about 5.09% of the common stock. Importantly, he also holds all 100 shares of series of preferred stock, which gives him that 51% voting control. The total shares held by officers and directors as a group are about 5.84%. The filings show that for the year ended the 31st of December 2025, the company's key insiders complied with their reporting requirements on time. This is where the company asks shareholders to approve Lumsden and McCormick LLP as their auditors for the 2026 fiscal year. The audit committee has already approved this, and the vote is largely a formality, but it allows shareholders to voice their opinion. The fees paid to Lumsden and McCormick LLP show an increase from 2024 to 2025. In 2025, the company paid $235,000, up from $187,300 in 2024. Audit fees make up the largest portion, followed by tax fees. The company has a policy to pre-approve all services provided by their independent accountants to ensure independence and avoid conflicts of interest. Approval for this proposal requires a majority of the votes cast. Abstentions and broker non-votes won't impact the outcome. This proposal is the advisory vote we mentioned earlier. It basically asks if shareholders support the board's ability to consider special dividends if the company sells off assets. Even if approved, the board retains full discretion. This needs a majority of the votes cast. Abstentions and broker non-votes have no effect. Here again is the critical stock split proposal. The company is asking for authorization to perform reverse stock splits anywhere from a 1 for -2 to a 1 for -250 ratio, or forward stock splits. This authorization would be valid for 2 years. The board gets to decide the specifics. This is a really important detail for context. Worksport already did a 1 for -10 reverse stock split back in March 2025. This past action is crucial because NASDAQ has rules about reverse splits. Specifically, if a company does multiple reverse splits that add up to a ratio of 250 for -1 or more within a certain period, they can lose their compliance grace period with NASDAQ. Since they already did a 1 for -10, they can only do another one up to a 1 for -24 ratio, before reaching that 250 for -1 cumulative limit, at least until March 2027. So, while they are asking for authorization up to 1 for -250, rules might limit what they can actually do in the immediate future. The company states they are not facing a NASDAQ deficiency notice right now, but they want flexibility. A reverse stock split is often used to get the stock price above the minimum required by NASDAQ, which is $1. They believe it can make the stock more attractive to investors and improve marketability. The main goal of a reverse split is to increase the per share price. However, the document warns there is no guarantee this will happen, or that the stock price will stay up. It also acknowledges that reverse splits can sometimes carry a negative perception among investors. This table shows how the number of shares could change. If they did a 1 for -250 split on their current 15.2 million shares, they would end up with just over 61,000 shares. This is a dramatic reduction and is meant to boost the share price significantly. If a reverse split results in a fractional share, the company anticipates rounding up to the nearest whole share and not paying cash in lieu of fractions. This is a detail that could impact very small shareholders. For us federal income tax purposes, a stock split is generally not taxable. You won't recognize gain or loss just from receiving fewer shares. Your cost basis in your shares will be reallocated. This proposal needs a majority of the voting power of all outstanding shares to pass. This is where Stephen Rossi's 51% control is critical. Because he has indicated he will vote for it, this proposal is very likely to pass. This is the backup proposal, allowing the meeting to be postponed to gather more votes if needed. A majority of shares present and entitled to vote is needed for approval. Brokers can vote on this, so broker non. Votes are not expected. Here we see details of transactions with people connected to the company. Stephen Rossi receives consulting fees through his company, 2,230,164 Ontario Inc., totaling $300,000 in 2025. His father, Lorenzo Rossi, as CEO of a subsidiary, earned about $186,000 in 2025. Importantly, the document states Stephen Rossi does not participate in decisions regarding his father's compensation. This confirms Stephen Rossi's significant control through his series of preferred stock, giving him 51% of the voting power. He can essentially control the outcome of shareholder votes. The company has a policy to review and approve transactions involving related parties, ensuring they are fair and comparable to market rates. It reiterates that Craig Loverock, William Caragol, and Ambassador Ned L. Siegel are considered independent directors, while Stephen Rossi and Lorenzo Rossi are not. This outlines the requirements for shareholders to submit proposals or nominations for future meetings, including timely notice and specific criteria, following SEEK rules. If multiple shareholders live at the same address, the company will only send one copy of the proxy materials unless a separate copy is requested. Another cost-saving measure. Shareholders can request a copy of the company's 2025 annual report, which was filed on the 26th of March 2026. The board is not aware of any other business to be brought up at the meeting besides what is listed. This just confirms the location and time of the annual meeting. So, what is my take on all this? The biggest story here is Proposal 4, the authorization for stock splits. Given the company already did a 1 for -10 reverse split in 2025, their stock price has clearly been struggling. The fact that they are even considering another one, potentially a very aggressive one up to 1 for -250, signals a serious effort to boost the share price, likely to meet NASDAQ listing requirements or attract institutional investors. Stephen Rossi's 51% voting control means this proposal is almost a done deal, assuming he votes as indicated. However, the history of reverse splits in microcap companies is often not a good one. Companies that do multiple reverse splits, especially aggressive ones, can be seen as struggling and sometimes end up delisted. For example, when Kodak did a 1 for 20 reverse split in 2021, holders saw roughly a 40% additional drawdown over the following 90 days. A $1,000 position there became about $600. While Worksport needs this flexibility, the market's reaction to such a move is uncertain. It could push the price up temporarily, but long-term sustained growth will depend on actual business performance, not just stock mechanics. The risk I am watching is whether this stock split will be a temporary fix, or if it will indeed lead to improved liquidity and investor interest, or if it signals deeper underlying issues that even a split can't fix. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.